Okay. All right. We are back. The New American Realist Show. I have a very special guest today, Brent Johnson, founder of Santiago Capital. I was honored for him to agree to come on to the show today. And I have just a few questions, and it's really going to be based on these rate hikes or non-rate hikes with pivot, non-pivot, because I believe this is just my opinion, of course, the only way you can possibly gauge these markets in today's crazy financial world, even though it seems, I believe right now it's harder than ever. But I would like to hear Brent's take on this, basically for the first part. So let's just say for the next 3 months, since we're almost in March until June, for the next Fed meeting, what do you think the Fed will do? Is it 25? Are they going to go higher? Just kind of give us your thoughts on that first. And what do you see for the next months?
Well, I think they're going to do 25, but 50 won't surprise me. And part of the reason is the markets have held up, overall pretty well. I mean, there's been some volatility over the last year, and obviously equities took a big, turn down last summer and into the early fall. But since then, they've rallied pretty well. I think markets are, 10, 15% from their all-time highs, depending on which one you measure it, which is not great, but it's not horrible, right? And I don't think the Fed minds if the market goes down. So I don't think that they mind if they hike 25 or 50 basis points and the market goes down another 10%. I don't think they mind. I don't think they want the markets to collapse, right? But in my opinion, they want the markets lower. They want the risk assets to fall. And part of the reason they want risk assets to fall is they want demand to fall. And if demand falls, then theoretically, inflationary pressures will fall. And so the idea that they're upset that the Treasury bills have fallen in price and that stocks have fallen in price, I don't think that holds any water. I think they wanted stocks to go down, and I think they wanted bond prices to go down. And the reason is because, those assets, both the bonds and the stocks, are used as collateral or margin loans or whatever it is to go buy more stuff. And so the only way, if you're trying to kill demand, you want to kill the underlying collateral off of which credit gets extended. And by contracting that collateral, in theory, they're trying to contract the demand. Now it's worked a little bit, but it hasn't worked a lot. But you can see that inflationary pressures are starting to come down, or at least the speed with which they are rising is falling. And so I'm not a fan of central banks. I don't think that they have necessarily done a good job, but if you understand why they're there and what they're trying to do, they haven't done a horrible job over the last year of getting inflation under control. Now, that doesn't mean they're not going to fail. That doesn't mean that I think that they are going to continue doing a good job. But if you think about it, and I know I'm kind of rambling here, but I think this is important to understand, it's almost a year now since they started rate hikes. A lot of these rate hikes that they've done might not even be into the full economy yet. A lot of times it takes anywhere from 9 to 12 months for a rate hike to actually start to show up in the economy. And so I think, so far it showed up a little bit, hasn't showed up a lot, but, by the time we get into Q2, then I think it's going to start to show up more. So I think, and I've said this several times, I thought that by the end of the first quarter, sometime in the second quarter, we will have a pullback, a fairly hard correction in risk assets. And at that time, maybe the Fed slows down, but even then, I don't know that they're necessarily going to stop. Now, I put a caveat on this, is that if the markets, they will stop when the market forces them to stop. Again, they want the markets to come down, but I don't think they want the markets to crash. So if the markets crash, then I think they'll stop. But until then, I think you got to listen to what they're saying and you got to expect them to raise rates.
Got it. So you're basically saying the crash would be, I assume, something like within 30% drop, something like 35% drop, like what happened over the COVID?
Yeah, well, maybe not. Maybe just back down to where we were last fall. At the end of September, stocks were at their lowest level in 2 years. The VIX was at its highest level in 2 years, and the dollar was at its highest level in 2 years, or like 20 years, sorry. And so it wouldn't surprise me at all to go back and revisit those levels at least. If we go through them, maybe we go through them, but I think we at least go back and retest those levels. The caveat I always give on this, though, is this is not a unique opinion. Sometimes I'm known for being a little bit contrarian. This view that I have right now, I don't think is a contrarian view. I think a lot of people have this view. The fact that the markets are up so far this year would say that they don't have this view. The retail's piled back into stocks and they think we're going to get this soft landing. And so, but I think there's a lot of people out there that agree with me that we are going to have either a tough landing or a hard landing. And so I don't think my view is necessarily unique. Maybe it's not consensus, but I don't think it's unique.
I don't think either.
And so, yeah.
I thought that the way I started, the more I started to look into your the way you present things on Twitter, and I watched a lot of your videos. I actually watched with Peter Schiff this morning early. I woke up really early and I listened to on China and USA. I thought it was very interesting debate you guys had. I look at you as more of a devil's advocate, and you started to open up my mind a lot more, just like the way you question things. And I really like that because you don't just look at the coin, okay, I'm set, it's going to be heads, or whatever tails. You're looking at it from every angle and trying to, ask questions that are not easy to answer for a lot of people that are kind of set on their thesis. Yeah. This is it. Bitcoin is going to 1 million. And then you would be the one, for instance, that's question it. Why are you saying this? I'm just saying one example. Or gold is going to 10,000 in 2025. And I really appreciate that because the more I follow what you do, is what it really opened up my mind to be a lot more careful with my investment strategy as well, what to do. Yeah. So you're basically, to paint this picture here, you're basically saying the Fed is kind of, the Fed did create a soft landing, even though, things can break at any moment. But for right now, they're doing a pretty good job.
So far they've gotten their soft landing. Now, again, I don't think that they will ultimately be successful in a soft landing. But if you're just looking at the actual reality right now, they've kind of gotten it, right? There's not too many people that a year ago, when they started hiking rates, thought that they would be able to hike rates to 4 or 5% without everything breaking.
I thought it was going to be a lot worse than what happened. I agree with that. So I got
the other thing that I think, let me make one point really quick before we go on. People always say, the Fed is going to have to reverse, and then they'll always say it's because of something in the U.S., the housing market or the stock market or the tax receipts, or they all have a reason why the U.S. is going to go into a crisis and the Fed will have to pivot. In my opinion, it's just as likely that the Fed has to pivot because something that happens overseas or outside the United States as it is inside the United States. Again, if you just focus on the United States, you can find tons of problems. And I acknowledge that the US has tons of problems. And a lot of people will say, these rate hikes are going to make the Fed pivot because they just can't sustain what's going on. Well, they seem to forget that last year, the Bank of England, the ECB, the Bank of Japan, the PBOC in China, they all had to interfere in their markets to keep them from crashing. So if you're worried about it happening in the US, I understand that. But on a relative basis, it's already happened elsewhere. And it wouldn't surprise me if a crisis, happens there, which then has knock-on effects into the US and forces the Fed to print for that reason, just as much as if something just happens domestically and forces them to pivot.
Got it. So go back to your call, 25. You think 25? Do you think things can get pretty much way rougher if they do go 50? Like, what's the percentage in your mind right now?
Sure.
Go back up.
Well, sure. And here's part of the reason why is it wouldn't shock me if they go 50 because, again, markets have, for the most part, held up. Risk assets have done well. The unemployment stayed strong. The inflation readings are coming down, but they're not crashing. And so perhaps they decide that they want to go 50. But the reason I think that we are going to end up having a downward move in markets, and whether this spurs the Fed to pivot or not yet, I don't know. But the reason I think we're going to have a correction is like I said earlier, for two reasons. One, a lot of the rate hikes that they've done over the last 9 months, it's not even a year since they did the first one. And a lot of the hikes that they did were last summer, which was like 8 or 9 months ago. And
Yes.
so as we move forward, let's fast forward 2 or 3 months. And let's say that they've raised another 25 basis points. Now, two things have happened. Now we've had a year since the first one. A lot of the rate hikes that they did last year are going to start showing up in the economy. And we are going to, at that point, we're going to start getting into the year-over-year inflation prints, which are going to be dramatically different than they were last year. So because now we're comping on 2022, so a year ago, we were comping on 2021. Inflation was very low. And so then when inflation came in high, it was like 6%, 7%, 8%. Well, now we're going to be comping against 6%, 7%, 8%. So if it comes in at 6, it's going to show 0% growth year over year. Or if it comes in at 5, it's going to show a negative. And so my point is we could get into a situation in the second quarter where inflation readings start to fall so much it almost looks like deflation, but yet they're still hiking. Do you see what I'm saying?
Yes.
And that is at the point that perhaps the Fed has to pivot.
Do you?
Again, I don't know for sure.
Yeah.
I'm just saying those are the things I have my eyes on.
Okay. I got a question here, which is a perfect way to, it's not even a segue. It's basically connected to this. It is from Twitter, from Corey Grant, 1987. I would want to thank Corey for submitting this question for you, Brent. At what level of interest rates does he, meaning you, think that the Fed is forced to pivot at, which is kind of what you explained. And this is kind of interesting that he put in. I've heard the real estate market blows up at 7%. We are now, I believe, 6.25 in that range, right? 6% for the 30-year fix, right? Okay.
Yeah.
What does a pivot mean for the milkshake? This is from Corey Grant.
Well, so it's a very good question. Now, the first thing I'll say is I don't know at what level the market breaks. It wouldn't surprise me. It wouldn't have surprised me if it broke at 4%, and it wouldn't surprise me if it breaks at 6%. It won't surprise me if somehow they're able to get to 8%. I just think that it eventually will. And so, I wish I had a crystal ball that told me exactly what level. But again, I'll make 2 points. One is that the rate hikes, in my opinion, are just as likely to cause a crisis in China or Japan or Hong Kong or England or Europe than it is to cause it here in the US. And again, all of those central banks had to intervene in their markets to keep them from going into a crisis last September. So the fact that the Fed continues to hike since then wouldn't surprise me if it causes those markets to go into a crisis again, which then blows back on the US. So I don't necessarily think something has to happen in the US for the Fed to either have to slow down or pivot. That's number one. The second thing is, how does it affect the milkshake? Well, this is where it gets very nuanced. If the Fed pivots and pivots quickly, then it probably makes the dollar fall because now interest rate expectations will be coming down. That's the reason the dollar has pulled back 10% over the last 4 months. At the end of October, it was at 104 or 114. Now it's at 104, 105. So it's down 10% since that time frame. The reason it's down 10% from that time frame is not because of de-dollarization and all of these other theories. It's down because rate hike expectations started to come down. The Fed started to slow down. The pace of rate hikes started to slow. And now the market is looking forward to the actual time that they stop raising and then start easing. That's why the dollar has pulled back. Now, what could happen if the Fed pivots? If the Fed pivots because markets are crashing, well, then that means the dollar is probably rising. So if you think back to 2020, on March 9th, the DXY was at 94. The Fed had cut rates to counteract the COVID concerns. And the DXY was at like 94, 95. 10 days later, it was at 102. Okay. Because markets were crashing and everybody needed dollars. And then they came out and they did the big QE, and then the dollar fell again. So to Corey's question, what does this mean for the milkshake? If they are cutting, that probably means the milkshake is playing out, because if the dollar is falling, they don't need to cut, right? The reason they would need to cut is if the dollar is spiking and causing chaos. And so if the dollar is spiking and causing chaos and that forces them to pivot, then it depends on how big they come out and how forcefully they do QE. Like in 2020, it was a it wasn't a bazooka, it was a tank. It was a nuclear bomb, right?
Yes,
so it really moved the dollar. If they try to do it slowly, but the markets continue to crash, think back to 2008. Markets crashed for a year, right? It wasn't just a 1 month thing. They went down for a whole year. Same thing in 2000. When the market started crashing in 2000, I don't think it bottomed until 2002. So it just depends on if they're not cutting quick enough, and if they're not reversing to QE quick enough, then it's possible. So even though they're pivoting, it's possible that the dollar still goes higher. But if they pivot, and that if there's not a crisis, if we're not in the middle of a crisis and things aren't getting materially worse, but they start to say we are now going to slow down our rate hikes and we may even pivot in the fall, if they were to come out and say something like that, at least on the headline of it, I would expect the dollar to fall initially. But what you have to remember is that when the dollar falls, these other currencies rise. And these other countries are in just as much trouble, and their growth is just as sluggish as the United States. So now those export economies now have a stronger currency. It's hard for them to grow with a stronger currency. So they will eventually then have to reverse as well. And this is exactly what we saw from 2020 to 2022. Initially, the dollar fell because they were doing QE. But then when people realized that everybody else was doing QE as well, and the US was kind of ahead of the curve, and then we're going to start raising first, then the dollar went to all-time highs, 214, 215. Or I'm sorry, 114 to 115. And so bringing this back to Corey's question again with the milkshake, I've said for a long time that this is.
Sorry, I would say for the listeners, I will paste and copy from Twitter if you don't mind for the quick explanation on milkshake. Sure. If you can just tell us, because somebody may not know, just 1 or 2 sentences what the milkshake is, because I find it beyond interesting.
So the milkshake basically says that because of all the debt in the world, we are going to go into a debt crisis. At some point, this debt will matter and we will go into a crisis. And when that happens, I think the dollar will rise, not fall. Okay. And when the dollar rises, I think the rest of the world will pour their money into the United States as a safe haven. So US dollar and US assets go up versus the rest of the world's currencies and the rest of the world's assets. But what I've said is this is going to take a long time to play out. I don't think this is going to play out over 2 weeks or 2 months. I think it's going to be 2, 3, 4, 5, maybe even 10 years. I really don't know. I just think that the end game that everybody talks about involves the dollar going higher, not going lower. And I've always said it will go in fits and starts. And so last year it went to 114. I always said it'd make a run, it would pull back. It would make another run, it would pull back. So, we went to 114, we've pulled back to 101 or 102. Now we're back at 105. Maybe it goes to 120 or 125, pulls back to 110. So my point, and the way I would answer Corey's question is that I think the milkshake is going to play out unless the only way I think it doesn't play out is if the Fed and the US government kind of unilaterally does a one-time devaluation of the dollar. But if they try to do these, just QE here, ease a little bit here, then it kind of forces the rest of the world to do the same thing. And that's why I've said the more the Fed prints, the higher the dollar will go. Because if the Fed prints $1 trillion, then Europe has to print $1 trillion. If the Fed does QE, then Japan has to do QE. If the US lowers interest rates, then China has to lower interest rates. Because if not, their currencies end up crushing their own economies. And so the dollar underlies the whole system. Like it or not, de-dollarization efforts or not, the dollar underlies the whole system. If the dollar is falling, the system is fine. The system needs the dollar to go down over time to exist. What breaks the system is if the dollar goes higher. And I think we saw that last year in 2022, right?
Yes.
That's why things were so crazy last year, is because the dollar was going higher. If you look back at any crisis over the last 25 years, the dollar was rising when it happened. Now, whether the dollar rising caused the crisis or whether the dollar rose in answer to the crisis, I think that's up for debate. But the correlation is almost 100%. So I don't think it's different this time. I think if we get into a crisis, you're going to see the dollar rise, and then that creates all kinds of problems on its own.
Because that is basically your thesis, which I understood based on listening and putting all the bits and pieces together from your videos, from a lot of people, from Real Vision with Grant Williams and Peter Schiff and all these guys.
Yeah.
Trying to put all these pieces together, I find it very entertaining and so interesting, because to wrap your head around, especially with your devil's advocate way, your attitude, the way you come out with questions, it starts to really question it, to the point like you got to come up with something here. Otherwise, people are going to all be taken for the cleaners. And you're basically saying when things actually fall apart, it's because of the Dixie, the dollar index, the dollar going up instead of going down.
Yeah.
And that's where you disagree with some
Yeah.
other people. They're saying, oh, everything is falling apart because of the dollar, the Dixie is going down. And your thesis is just opposite.
Yeah.
It looks like that is exactly
Right.
what's happening. And when it comes to these interest
rates, and to be honest,
yep, go ahead.
Go ahead, sorry. Go ahead.
Oh no, you go ahead. I want you to chime.
I was just going to say the reality is I'm very for the people who take a look at America and analyze what it's happened over the last 20 or 30 years and look where we are from a debt perspective and look where we are from an influence, and the diplomatic efforts around the world, or lack of diplomatic efforts, however you want to define that. And they look at the politicians that we have in power and the types of policies that they're running, and they get very bearish on the United States. I completely understand it. It's very rational, and the analysis is not bad analysis. The problem is when you do that, you get very siloed in on that, and you don't realize that the whole world matters as well. And it's a big world, and it's a relative world, especially in the currency world. So it's the analogy I'll use is if you were playing basketball at recess, if you're a kid and you're playing basketball at recess and you got 10 players and all of them are just horrible 10 players. They can barely dribble, they can't shoot, they can hardly even walk, but one of them will be the best out of all the 10, right? And so that's kind of like the US. I'm not saying the US is a great basketball player. I'm just saying the US is a better basketball player than most of the others out there. And so part of the reason I push back so hard is I don't want people to get blindsided, and I don't want them to get crushed based on this idea that just because the US is in bad shape, it's going to crash and the American economy is going to go to ashes and the US is going to lose its role in the world, and the dollar is going to lose global reserve currency status, and we're just going to be this big heap of ashes and the rest of the world is going to be this utopia. It's not going to work like that. And the other thing I want to point out is even if my thesis ends up becoming correct, which time will tell, it doesn't mean that the US doesn't get hurt. If I'm right, the US gets hurt a lot. It's just that everybody else gets hurt even more. So, I don't want this to come across. Yeah, exactly. And I don't want this.
Yes.
Exactly. And I don't want this to come across as this, this American exceptionalism and we're the greatest in the world and nobody can do anything to hurt us. That's not my view at all. But the point is if you can remove your emotions from it and just look at everything objectively, the US has an enormous amount of resources and advantages that the rest of the world just doesn't have. You may wish it wasn't that way, but it just is. And when you're putting your money on the line, in my opinion, you should invest what's going to happen rather than what you would want to happen. And, part of the reason that when I kind of first figured this out for myself, one of the reasons I knew I was on the right track is because I hated the answer. I really did. So I didn't think it was right. I didn't think it was moral. I didn't think it was the way I thought the world should be. But once I realized it's the way the world is, and that's what really affects markets, then it kind of helped me look at things a little differently.
Got it. So based on your experience investing, trading, being the fund manager and everything, do you find this period right now, or we should say this decade in a way, the way it's shaping up, and especially right now, 2023, do you see it as the hardest environment to trade, meaning short-term trades and investing long-term, or not? That would be my last question.
Yeah, I mean, it sounds cliche, but I really think it is. I mean, it's really hard. And the reason is because the people that say inflation are here, they have very good reasons to say inflation is here. The people that say we're going to have a deflationary bust, they have an incredible amount of evidence to support their case, right? The people that say go buy gold because the governments can't be trusted, they have a very compelling case as well. And the people who say just sit in cash because oh, none of this can end well, they have a very compelling case as well. And then the others say, well, you should buy equities because look at, over 100 years, equities go up. So, just don't try to trade every little swing. They have a compelling case as well. And then, if the dollar and the fiat currencies get debased, equities typically go up. So I feel like everybody can make a fairly compelling case right now, and the problem is we've gotten to the point that whichever one happens, it could happen in an extreme way. So we could have extreme deflation. We could have extreme inflation. We could have a big boom. We could have just a big bust. We could, we could have a war, unfortunately. And so it is very, very hard right now. But I love it. It's kind of like the Super Bowl. Like if this is what you do, it's kind of what you dream of. It's a nightmare, but you kind of dream of it.
Yeah, I'm sticking with mine again. This channel is from my side definitely not. I'm not a licensed financial advisor by any means. My stance is very simple. I'm a hard assets guy. I'm all about tangibles, making it very simple in this environment. I am in a way not stuck because I also like dividend paying stocks that are down for me. Like I like Rio, for instance, Sibanye, Stillwater. I like those kind of plays that pay pretty big dividends, Exxon, stuff like that. So that way, when the downturn does happen, I'm kind of offsetting my loss a little bit with the dividends, and I'm playing it in the long term for the entire decade. I'm not investing all that like I'm going to get hurt, even though it's hard to watch when it's down 25, 30%.
Yeah.
So,
yeah. Well, I think the main thing for me is that, and again, part of the reason I pound the table so hard on the dollar is not because I want everybody to sell everything they own and just go put their money in cash and hold dollars. That's not it at all. But part of the reason I pound the table on it is I talk to so many people and they think they have a good idea, and maybe they do have a good idea, and then they go and put half their portfolio in it or all of their portfolio in it. And to me, that's, there's never been a more uncertain time, in my opinion. So to have the certainty in this environment to go put 50% of your portfolio on something, I think that's too risky. So I'm a big believer in diversification. I'm a big believer in keep an open mind. I'm a big believer keep some cash on the sidelines so that if something crazy happens, it gives you some optionality to go in there and use it. It also allows you to kind of maybe you pay some bills while the rest of your portfolio is depressed for a little while. So again, I think you need to have a healthy sense of skepticism for not only other people's views, but your own views. And then, when you do see an opportunity, you don't go all in on it. It doesn't mean you can't make an allocation to it. Doesn't mean that you can't, take even an oversized position. But I see no reason to go all in on anything at this point.
Got it. I feel the same too. And I really like the fact when it was a lot easier to do a lot of trading and I was going in and out a lot. That was kind of my strategy. And then acquiring real things like I would buy, whatever cattle. I know that you probably are not into that, or I would buy some physical gold and just stack it up. Platinum is a big plane of mine as a contrarian player in the platinum, but I'm looking at it as just to protect, as it's not a for sure thing. It's just I sleep better at night knowing that I have something real in my hand, and that's what I've been telling people. But to finish off, just real quick, you mentioned basketball. Did you play basketball competitively, college, or by any chance?
I did. I played all through. I played all through college. My wife played in college. So yeah, it was a big part of my life for a long time. But I'm old now. I don't play anymore.
What position did you play?
I was kind of a small forward or a power. I was more of a small forward. I was, they played me at power forward sometimes because I was tall, but I'm really more of like a three, like a small forward.
Got it. So
I loved it. It was great. I played for a couple of years at the University of Kansas on their junior varsity team, and then I transferred to a small school in Kansas City, and I played there for a couple of years. And it was a great experience, and man, it was some of the best days of my life. But maybe the competition from that is what kind of helped me get competitive in this business as well.
that's why I said, because you mentioned Super Bowl, and that's exactly what
Yeah,
I'm reading to. So this is basically Game 7 of NBA Finals for you, and we're
it
gonna,
kind of is.
yes, we're gonna end on that. And I really think this was very beneficial for a lot of people. And Brent, thank you so much again for taking time for such a small audience channel like this to come on. I thought this was very helpful again, and I really thank you. I appreciate it.
You're welcome. You're welcome. Thank you for having me. I enjoyed talking to you.
Thank you so much, and have a good one. We'll talk soon, hopefully one
All
day.
right.
Take care.
All
Bye.
right. Bye bye.